Hey, what's going on everyone? It's Griffin here, and in today's video we're going to be speaking about exchange-traded funds, ETFs for short, that honestly have shocked many investors over the past 12 to 24 months with returns that have been severely above historic annual averages. Right, the traditional narrative of roughly 8% market returns annually in, say, the S&P 500 have been eclipsed over the past couple of years, with returns of 31.5% in 2019, 18.4% in 2020, and year-to-date around 27% in 2021. And let's keep in mind that 18.4% returns in 2020 is despite the more than 30% drop that was experienced in March of that year. The markets still managed to bounce back from the quickest bear market in history to come and provide buy and hold investors with roughly 18% returns. That's pretty incredible for doing absolutely nothing. And if you are a bit more active and dollar cost averaging into the market throughout this course of time during the drop, then your returns are probably more in the range of 30 to maybe even 50% on the higher end over the course of 2020. And that's for doing pretty much nothing with the most passive ETF that you can invest in. But with returns as high as we've seen in 2019 through to, well, this year, why is this and how really is this possible? Well, without jumping into a history lesson here to bore everyone with information you're probably already somewhat aware of, 2020 was a pretty rough year with job as well as economic uncertainty. That has also segued over into 2021, and we're still feeling these effects to some degree, mostly qualitative effects, but also some quantitative effects. For example, we're seeing higher levels of inflation right now than we've seen in over a decade. Among other things, though, the main reasons that the US government, faced with this uncertain time and pretty much the economy in shambles, decided to turn on the printing presses and printed trillions of dollars worth of new capital and distributed it into the economy. To put this into perspective, this graph right here shows the total US M1 money stock, and all you really need to understand is that from February 2020 to October 2021, which is only a month back, roughly 80% of the total money supply has been printed and circulated in the market to stimulate the economy and, well, kind of prevent it from collapsing. And this definitely had an impact on the stock market as well. So that's exactly what happened, and I dug into this significantly more in the inflation video that I made a couple weeks back. Definitely check that one out if you haven't already, because we speak about, well, considering the higher inflation levels moving into, well, now, but also moving into 2021, how does this usually impact what the Fed decides to do in terms of interest rates, and, well, how does this also impact market returns? But it's also pretty much unrealistic to think and assume that inflating the money supply to the extent that we saw over the course of these past 24 months would not have any negative repercussions on the relative buying power of the dollar. And really, investors have been anticipating this, despite the fact that both the Canadian and US government have stated at the beginning of 2021 that inflation wouldn't be too severe, would stay within targets, and would be transitory. It's ridiculous to think that increasing the money supply this dramatically wouldn't have an effect on the relative buying power of, once again, the dollar. So what does this have to do with the stock market, though? Well, you may have guessed it, that with more capital on hand, in parallel to the fact that we're seeing higher levels of inflation right now that is eroding away at the buying power of this cash, investors have pretty much poured their money into cash generating assets, as well as other assets that have a much better capacity to store value and relative wealth. And this has resulted in basically every single market increasing in value significantly because so much more capital has been poured into it. When there's more demand, usually the price goes up, considering the same level of supply. We've seen this in the stock market, the real estate market, as well as even crypto, and even the commodity markets have seen a significant inflow of capital, although this is also as a result of a couple other reasons. What's incredible and even somewhat alarming, though, is the fact that as of September 2021, over $1 trillion has flowed into the global equity markets in 2021 alone, which happens to be more than the last 20 years combined. And if we zoom back even further, as of around April of this year, investors have put more money into stocks over the past 5 months prior to that than the last 12 years combined. Think of this for a second. In one single year, more capital has flowed into the equity markets than the past 20 years combined, which is more than during the 10-year bull run that we saw between 2009 and 2020, where the S&P 500 gained over 380% in value. So the question is, where has most of this capital actually gone within the US stock market? Because yes, we are seeing prices at all-time highs from an actual dollar standpoint, but also we've seen the relative underlying value of the US stock market market increase in parallel to this. Taking a look at these charts here, which if you follow my channel, you're most likely already well aware of these because we look at them quite often, but the relative PE of the S&P 500 is trading at around 21x right now from a forward standpoint, right? The forward PE, which is higher than anything we've seen since the early 2000s. Even before the Great Recession of 2008, forward PE values for the S&P 500 were at around 15x to 16x. This is not the case though for both small and mid-cap stocks, or if we take a look once again in the US stock market here, where again we're seeing values that are directly in line with historically commended PEs. In fact, these small cap stocks are trading below historic value averages in the roughly 14x range. So it's safe to say then that the bulk of this capital that's flowed towards the US market has been towards large and mega cap companies, raising their price but also their underlying forward PE values, which by the way have been maintained now for roughly 2 years. Taking a look at this chart, since these companies have been posting fantastic net income growth. But yeah, there's a reason why US billionaires have piled on an extra $1.8 trillion over the course of the pandemic. If you look at who these are, we can see that they are all major shareholders in top companies that make up the S&P 500, like Amazon, Tesla, Microsoft, Facebook, Google, and so forth. In fact, these top 10 companies make up roughly 30% of the entire S&P 500 index, meaning 10 companies control 30% of the market movements compared to the rest of the 490 companies that make up this index. And most of these top 10 companies have taken in significantly more capital than any of the other categories of stocks in the US stock market, like medium as well as small cap stocks over this past 2-year period. That's why when taking a look at, for example, the actual S&P 500 versus 5 of these top 10 companies on a stock chart over the past 2 years, we can see a significant discrepancy in the returns that were generated. So let's then speak about my thoughts surrounding whether or not you should continue investing in ETFs despite being at all-time highs right now. First of all, I think this should go without saying though that I am speaking about core ETF positions, right? Broad low-cost index funds such as, for example, the S&P 500, the NASDAQ 100, maybe even a total US stock market index, as well as some small and mid-cap broad market indexes. I'm not speaking about more industry-specific as well as other targeted ETFs, like for example, an active ETF like an ARK or whatever. I'm really speaking about the broad market here. First and foremost though, based on the fact that we are seeing very high price points in these broad market indexes though, well, yes, moving into 2022, expecting higher levels of inflation right now and moving towards, the start of 2021, as well as increases in interest rates, well, this does typically have a net negative impact on equity returns as it becomes more costly to borrow funds, and investors can also make more capital or interest just on actual cash holdings rather than in the stock market. So usually higher interest rates does have a net negative impact on the equity markets. That is something to keep in mind, but that is going to be in the big picture on a much smaller scale over the course of the next couple of years. But the way I see this is that further to be a significant crash over the course of 2022 or maybe the year after, there would need to be a massive amount of capital exiting those top companies that make up the S&P 500 that we just spoke about earlier, right? Mainly in these top mega cap companies like Amazon, Tesla, Facebook, Google, etc. And that despite higher valuations, these companies are still posting fantastic financial growth figures over the past couple of quarters. Q3 2021, for example, that was reported just recently, was an absolutely insane quarter for companies like Facebook, Google, Amazon, Tesla. All these companies have been showing massive levels of both business but as well as financial growth in this past quarter, as well as Q1 and Q2 of this year. Now, with that said, there is definitely a very large discrepancy right now between capital flowing towards mega cap companies versus the rest of the stock market. And the same thing applies to these businesses in question, where these larger companies are significantly dominating the industries and markets that they're operating in. For example, once again, Facebook, Amazon, Google, these companies are all dominating their respective industries. And I really think that moving forward, this is only going to become a larger and larger gap. So considering where markets are right now though, and also considering the fact that interest rates have not yet increased, even though we do expect them to increase in the first half of 2022, that's not the reality as of right now. It will probably or most likely impact equity price points in the first half of 2022. But right now, if you were to sell your positions and go back to cash, you're essentially accepting that you're going to be losing buying power over that period of time with the much higher level of inflation that we're seeing in the current market environment. So it wouldn't necessarily make all too much sense to do so right now. Staying invested in the market, even if we do see some volatility over the coming months, is usually going to be the better course of action over a long-term investment strategy, unless you're Elon Musk, for example, and you want to tell the US government to stick it. By the way, the insider trades we just looked at for Elon Musk and other insiders of Tesla were seen on Bull Runs, which is a full stock market research application, as well as portfolio tracker and community that I've been working on for the past several months. It launched a couple weeks back. We've done some massaging to the overall product offering, where now you can sign up. We have a full free forever plan where you can add one portfolio and you get a limited amount of stocks that you can research each month. So definitely make sure to check that out down below in the description. Once again, there's a completely free plan, and we've also changed it to only $5 a month for absolutely all the features. So yeah, check that out, link down in the description. So where does this leave us then in regards to investing in ETFs, and what should you be mindful of? Well, first of all, let's quickly cover the difference between lump sum investing and dollar cost averaging, even though this is something we do speak about quite a bit on the channel. So first of all, dollar cost averaging is when you're periodically investing into the markets a certain amount of money that you're able to invest regardless of where the market is on that given day or given month. Just continuously investing into the market, whether or not the market is up or the market is down, and maintaining this for a long period of time. On the flip side, lump sum investing is when you have a larger amount of capital, or pretty much any amount of capital that you have on hand, and you just invest it into the markets one single time instead of spreading that out over multiple different buying periods at different points in the market. Now, even though I personally speak about dollar cost averaging on the channel, and this is what I do myself as well, historically speaking, lump sum investing will tend to perform better than dollar cost averaging over the long term. In fact, based on a study conducted by Northwestern Mutual Wealth Management, based on a 10-year rolling average starting in the 1950s, lump sum investing beats dollar cost averaging roughly 75% of the time with a 100% equity portfolio, and around 80% of the time when it comes to a 60-40 split between equity and fixed income positions. And this is over a 10-year period. So yeah, when it comes to retail investing on a much shorter time frame, lump sum investing comes down a lot more to timing the market, which can go in your favor or not when you're looking at it on only a 1 or 2 year time frame. And since it's pretty difficult to time the markets in the short term, although some people say that they can do this, well, the average individual is not able to accurately time the market. So if you do lump sum invest, you could be in a position where you invest at the correct time and, well, the market goes up significantly. But if it goes the other way in the short term, not in your favor, well, you don't have any more capital to deploy into the markets and take advantage of the dip or the larger correction. So what I like to do then is basically a mix between lump sum investing and dollar cost averaging, where I invest as much as I can each month though into the markets regardless of where the markets are, right? Instead of saying in 2021 I'm going to have $10,000 to invest and put it all into the market at the beginning of the 2021, instead of that I just try to invest as much as I possibly can each and every month into the market to over the long term have the highest return possible. This is something I speak about a lot on the channel, where I recommend taking the information that you see on my channel as well as other sources on the internet and then tailoring them and massaging them to your realities, including your risk tolerance as well as your investor profile overall and that time horizon that you have to invest in the markets. The reality is that a lot of investors take short-term news way too seriously in their long-term view of the markets. It's just fun to stay up to date with what's going on, but 9 times out of 10, none of this matters. It just clutters your mind and doubts the overall process that you have for sticking to your investment strategy over the long term and consistently buying into the markets and your favorite companies. And finally, before we speak about what I've been doing, I'd like to leave you with this. It's also important to remember that all-time highs are going to be subjective to the time period that you are investing in, right? People, investors say 20, 30, 40 years ago may have been saying the exact same thing, that we're seeing all-time highs, right? Because they were all-time highs back then. But that all-time high back then was basically an arbitrary value at the time, even though over the long term, it's on an upwards trend. If you are well aware of your risk tolerance and your investor profile, which you should if you're investing in the markets, then you really should not stray from your long-term investing strategy regardless of what happens in the short term in the markets. Basically, all-time highs today could be relative value 10 years down the line. All right, so to end off this video, here's pretty much what I've been doing over the past couple of months, and it has not changed, right? So I invest in the markets every single month, usually on a weekly or bi-weekly basis, depending on how the markets are trending. Personally, I've also been holding around a year's worth of expenses in cash in a savings account. Even though this is not the best use of capital whatsoever, it really is not, and it's also going to be eroding away at inflation right now. This is just something that I've personally decided to do based on my situation and my investor profile. Usually I speak about around 6 months worth of expenses. As someone who makes money on the internet through YouTube videos, though, I just feel personally more comfortable with having around a year's worth of cash in savings at all time. That's making a small amount of interest each and every year. I've also been focusing on purchasing more cash generating assets, so dividend stocks, but then also real estate, which I know is not feasible for everyone watching this, but this is something that I want to share with the audience as it is part of my overall investing strategy, and I'm actively always buying real estate because I'm able to guarantee certain returns and cash flows that are quite significant relative to the investment that I put in. So that pretty much wraps it up for today's video, where basically the whole point of this was to speak about whether or not investing in index funds near all-time highs is something that still makes sense. And, despite the fact that the markets may go down over the next year by 10, 15, 20%, it's a possibility. No one really knows, but I just consistently purchase into the markets. And this is something that other investors like Warren Buffett also speak about, consistency in their investment strategy, and that the average retail investor should just consider investing in low-cost broad market funds, as you're basically investing in the growth of the American stock market, as you're basically continuing to invest in the growth of the US economy. So I really hope you enjoyed today's video. If you did, you know what to do. Make sure to drop a like on this video. It really helps my channel out, and I'd highly recommend you subscribe and hit the bell button to be notified of new and upcoming content. Also, don't forget, we have so many videos already posted on the channel speaking about extremely important topics around investing in the stock market. And don't forget to check out the links down below in the description for resources I use and recommend. You can get some free money there for signing up and opening certain accounts, as well as my full stock market investing course, where you'll learn everything you need to know about stock market investing. By the way, if you have any questions about that, feel free to DM me on Instagram. I'll be happy to answer any of your questions. And last but not least, don't forget, you can sign up completely for free for a forever free plan on bull runs, link down below in the description. So thanks a lot for watching today's video. I hope you enjoyed it, and I will see you in the next one.